Well, all right, you guys. I want to watch this video again, and I'm going to do it with you.
It wasn't that different from the stock trading I did on tech platforms in the early 2000s. Having developed algorithms to seek alpha and outsmart the market, I had a natural affinity for understanding auction marketplaces and was able to capitalize on that in the digital space. From keyword search optimization to targeting YouTube ads, we tested it all. On the digital side, content was only as valuable as the data it produced. How efficiently a company processes its proprietary and customers' needs and implements data-driven solutions, it defines success. As a company, we had content creators, but until we built our technology platform, Vocal, we did not have the data feedback loop needed to exponentially scale. Today, we are one of the most important platforms in the creative community.
This is the CEO
with over 1.5 million
Inc.,
subscribed creators of all types and their audiences of nearly 1 billion people. As a creator-first platform, our primary revenues are driven by monthly subscriptions for services and products. Vocal is a SaaS platform for the creative community, providing a home base for creators to best monetize their content and discover a new audience. Soon we realized that we could apply our data to champion meaningful and authentic user-generated marketing campaigns. And we have worked with some amazing top-tier brands. But where we really shined was working with up-and-coming entrepreneurial brands, looking to reach a broader audience and find relatable storytellers. We had an edge in identifying and acquiring CPG brands that resonate with our creators and their audience. And after 4 years of battling on the OTC marketplace, we uplisted to the NASDAQ in September of 2020. After 2 years on the NASDAQ, we were finally creating growth at a multiple of our ad spend, and we were approaching cash flow break-even. I have presented this story to folks like you at many conferences just like this. I've told that story that I just told you many times. It is a fundamentally strong story. But today I am here for a different reason. I'm here to tell you that there are significant technical reasons to buy our company Created. Equal to the fundamentals, if not far more promising for our investors. Naked short selling is pervasive on Wall Street. And no small or micro-cap company, many that have presented here today, can maintain their hard-fought gains in their stock price for long until something radically changes. I have only seen that happen a few times in my career. For many of you who are listening, it has been decades. We have watched, and worse, too many have turned a blind eye. I could not believe it myself in the beginning, but I do now, no question. Here's how it works. Let's say there's a buyer of 10,000 shares of Created at the market. The market maker fills it immediately. How or why that particular market maker executes your order, that's a broader conversation. But at this point, the market maker who sold you the 10,000 shares is in theory supposed to have carried out a locate and a bona fide borrow. Bona fide means real and genuine, but it is purposely ambiguous. Otherwise, they would have used the words real and genuine in the regulation. It ostensibly allows a market maker to maintain the short for as long as they can without the actual physical, real and genuine borrow. The stock loan department, which again in theory is a separate department from market making, might still go ahead and charge interest to whichever fund they executed on behalf of, while the market maker profits off further trading. The reason all this is possible is because at the end of the day, all of them are beholden to the institution's central book. The central book is, in theory, supposed to bring balance to the broker-dealer's positions in transactions, from cash to securities. It is covered by the SEC's broker-dealer books and records rules. In worst-case scenarios, it is now my understanding that the central book informs the market-making desks that they have met the requirement to short, irrespective of the position, because in theory, it is a proprietary trade of the central book itself. Prop trading and stock loan businesses are two of the biggest revenue generators in the entire financial services industry, all at the expense of the retail investor, all at the expense of the shareholders, of the people investing in the companies presenting here today. And then there is spoofing. Spoofing is the behavior you see sometimes with market makers algorithmically trading amongst themselves, lowering the value of stocks. In doing so, they make money either in an institutional proprietary book or for the fund that the sell side shorted the stock on behalf of. And when it's time for that market maker to cover for various reasons, they just reach out to another firm, buy the 10,000 share position from them to cover. Now the new market maker is short and the clock starts again. And that's why if you look at our stock, or many of the other stocks I'm talking about, you'll see all these intraday crosses of large shares of stocks, from one market maker to another. I'm told that some fails and cross trades move around the globe from Canada to Hong Kong across dozens of countries. The whole system allows the stock loan groups to become, well, they can blame all sorts of logistical issues on why they failed to deliver and become irresponsible if ever asked. Every share they short after that first trade failed that is not borrowed is in theory creating counterfeit shares. You heard me, counterfeit shares. And the buyer has no way of knowing or understanding how this impacts them. Because if and when the financial firm is asked to deliver physical, it would be revealed that the central book may have even inadvertently created a synthetic float. This hurts publicly traded companies for no other reason other than greed. As far back as United Airlines at the turn of the century to GameStop and AMC more recently, the practice of naked shorting has wiped out the savings of many hardworking Americans. It has destroyed their pensions and eliminated their jobs. From pilots to bag handlers to grocers, technologists, and scientists working on life-saving medications, as you've heard about today from biotech companies. Naked short selling creates a deteriorating financing capability for the underlying company, and it helps drive the toxic lending environment that dominates the microcap space. And who pays the price? Unchecked, it can be a death sentence for a company, irrespective of the company's intrinsic value. I know it nearly killed my company. Here we are on the verge of 2023, and still no one in authority has fully addressed the issue. Over the last few decades, what was once a discreet handshake between a few stock loan departments has turned into an institutionalized, technology-driven money-making machine. And it does not matter that they get fined millions or even a few billion. They treat it as a line item. It's just another cost of doing business. As the electronic trading world exploded, stock loan regulation became archaic and literally could not keep pace as a business with the likes of technology platforms like Robinhood and E-Trade. I believe the exponential growth of hedge funds made it mathematically impossible for the banks to actually support the borrow demands over the last decade. The world markets collapsed in 2008, and by the time they were resuscitated by the government, technology had inserted itself systemically into the back office of the stock market. And within 10 years of that moment, 400 years of a business driven by commissions ended, and we started trading in fractions and decimals for monthly subscriptions, free trading. Providing liquidity and balance sheet arbitrage became all the rage on Wall Street. Naked shorting became institutionalized. The loss of commissions was made up for in the lending departments or prop trading. Prop trading, the central book, became the biggest revenue generator in many of the biggest financial institutions around the world. I want to be clear. I believe there are hedge funds that engaged in naked shorting practices in our stock. I am directly engaged in battles with some of them. They would say differently, and given the opaqueness of the regulations, I'm sure it would be a hot debate. But the real culpability is with the system that fostered the funds. It's no different than the system that fostered Bernie Madoff. There is no longer a secret. There is enough evidence and technology surveillance algorithms to at least prove some of it. Go to sec.gov or buy-ins.net. Look at the facts. Do your due diligence. And read or watch the attorneys who are fighting on the front line and what they have to say. Every CEO here at this conference should listen to what those attorneys are fighting for. They are fighting for us. Now, let's talk about what I think might be coming and why I think Created and many of its technical peers are very attractive stocks. I believe some financial institutions could be crippled if forced to deliver on all the unborrowed small cap stocks at once. It would create the opposite of a flash crash, an implosion to the upside that could wreck institutional balance sheets. Because theoretically, they are the ones taking the risk on the naked short side. In some ways, if legislation was actually enacted to more severely restrict the practice, it could actually have a negative impact on the financial services industry and significantly benefit the retail investor. The market-making machines are responsive and driven by algorithms whose initial intention was to bring liquidity to the market, meaning fill the orders, fill them no matter what, fill it millions and millions of times. A stock literally could get 3, 5, 10 times short its actual issued and outstanding shares, which logically creates a massive squeeze when the company busts the shorts. We found out during the pandemic that giving people money is good for the markets. Tech stocks, which make up a significant portion of the S&P 500, soared. And with bond yields so low, investors didn't really have a more lucrative place to put their money. With the massive influx of global retail investors came increased demand for these lower valued stocks that are so easily manipulated. New buyers spurred on by social media and the ability to work collectively drove demand. And slowly, over the last 3 years, I believe that the exposure the institutions have on the short side without bona fide borrows may be enormous, irrespective of their intentions.
Maybe.
Today, our company Created announces 3 initiatives to combat naked shorting abuse and create value for our shareholders. First, we have formed the CEO Block, an organization whose mission will be uniting the executives and shareholders of companies being abused by naked short sellers. As a block, we will approach the financial services industry. The website ceobloc.com will deliver the plain truth, without concealment or embellishment, and I encourage you to sign up to learn more. We have the financial backing and determination to succeed. We will use our proprietary data to target politicians and regulators through social platforms and other media distribution channels, and we will demand change. Second, I will personally be reaching out to the heads of legal and compliance groups at the major institutions and the market-making firms to discuss the behavior in our stock Created. They are required to be responsive. As someone from their world, I do not fear them. I know what to ask and who to challenge, and I will distribute their responses to me transparently to all of you. Third, and most important, today we announced a letter of intent to sell 25% of our OG collection subsidiary, our media library, for $2.5 million, creating a $10 million plus valuation on one of our subsidiaries. The press release literally went out moments ago. This is ahead of our planned spin-off of the new company on the OTC marketplace. I expect the market to value the spin-off at a multiple of its pre-money value. I'm thrilled to have this opportunity to jumpstart the OG Collection's multiple business strategies, as well as advance its Web 3.0 plans. Additionally, we look forward to monetizing the hundreds of thousands of original images in our vast media library through sales and intellectual property-related transactions. But equally important to me is the tactical advantage that the spin-off of the OG Collection subsidiary provides as either a dividend or a new security for all of our created shareholders. Now, when I say all of our created shareholders, let me be clear. We intend on distributing the majority of the new public company only to issued shares of record. Let's assume hypothetically that there are well over 100 million shares naked short. If every shareholder loaned all their shares out, it would require buying multiples of our float to cover the demand. If all the shareholders requested delivery of the new OG Collection spinoff, there simply would not be enough shares in the new company for all the potential counterfeit shares to be filled.
Boom.
In theory, created stock should move significantly higher on these technicals. We will have trapped the naked short sellers in two stocks when it was their intention to have abused us in one. I want to thank you all for listening today. Anybody who has questions on any of this, you can contact my company and feel free to ask for me and chat with me directly about it. Thank you very much for your time this afternoon.
That guy's a hero. So there it is. That's created CRTD, and you heard him. It's been as high as 170. It's now, I think it closed at 69 cents in this bear raid that's going on in all stocks. But he's going to spin off a company at a multiple of the valuation, which the investor put up $2.5 million for 25%, so the valuation was 10. At a multiple of that valuation, he thinks. And it's going to create two companies, which the shorts are short. It's a pretty compelling story, and that guy's going to fight for his name, by the way, is Jeremy Frommer, a SUNY Albany graduate. He's going to fight for CRTD, but if you think he's going to go easy on the shorts in FNGR, the Lind Partners out of New York City shorted CRTD. They have big smiles. They have a prestigious Madison Avenue address. Their website is full of facile descriptions of their abilities to manage and building up their skills. But all they do, just like Kurt Kramer and Seth Kramer and Charlie Mayo at Power Up Lending, in my judgment, all they do is just, as before, during, and after the signing of toxic death spiral convertible notes to these over-the-counter companies who are starved for capital, starved, because the system, Wall Street, has set up an environment where stocks under $5 are not followed by research. Brokers at the big firms cannot recommend purchase of stocks under $5 or $7. Institutions cannot buy stocks under $5, $7, $10 or under $350 million market cap. And so there's no buyers in the over-the-counter markets, none, essentially, unless it's a group of ragtag retail investors. But retail investors can only buy once with their dollar. The naked shorts can just counterfeit shares like a mimeograph machine, just print, shroom, shroom, shroom. And the horror of it is they can sell these shares all along to depress the price of the stock. But when there's a downturn, when there's a tough day in the market, they can just crush it because they just create shares out of thin air. They do this under the auspices of the Reg Show exemption. In the United States, there's 4 tickets that a broker can write: buy, sell, borrow, legitimate short selling, borrow, and Reg Show, which is an exemption to the settlement system. And it's provided to market makers. So there's a bunch of seedy market makers. We don't need any more now that we have computers. But they run the businesses for big funds, fund them. Prime brokers lend them the money. And their whole business model is to steal from you. And the SEC allows it. FINRA allows it. Journalists, there are no Woodsteins anymore. There are no real journalists anymore. No one studies. And what basically happens is these death spirals are issued. The company's starving for it. I'll give you a recent example. I think it was B-Bag. It's the Lind Partners. They lent face value $10 million. The company only gets $8.2 million, and it's only done in tranches of a 20th of the note at a time. I am certain in my judgment that the Lind Partners started shorting the stock prior to signature. So essentially, because the markets don't function for small companies, they shorted the capital raising markets. That's what the United States used to be good at, raising capital for ideas. They short it, and then they give the company's own money. And as soon as the signature comes in, they just sell. And this is what happened to Created. It's what happened recently to a company called FingerMotion. FingerMotion signed up with the Lind Partners. All smiles. We're going to help you out. We're going to, come grow with us. In the span, the numbers for Created, and you can check them out, the numbers for Created are rumored to be 330 million shares naked short. Shares that do not exist. Shares that will not exist if you listen to the chairman. He's not gonna help the shorts out. 330 million naked short, counterfeit. People go to jail for that, and if it's dollar bills. But in Wall Street, they're heroes. You know why it goes on? According to Pat Byrne, Goldman Sachs makes 75% of its income in the stock loan department. 75%. And Ken Griffin at Citadel and Virtue and these other big aggregators of assets, they have conned Congress into believing that somehow they're providing a service for you by providing liquidity. Funny thing is, there's no liquidity on the downside. If the market turns red, where are they? They're not there. They just join in the slaughter. So CRTD, a great company, has the last time I looked, outstanding 30 million shares. Outstanding. The float's smaller. And there's 330 million shares naked shorted that don't exist. And you've got a fighter, the stock's 69 cents. Boys, there's some explosive upsides in a short squeeze there. Finger, which I followed for years and years and years, a great story. It's a company that has 3 basic income streams. One is top-up cards for minutes, buying minutes in China. They are one of, I think, 2 or 3 that can buy the minutes. It's essentially from the government, but through China Telecom at a discount. And then they just sell it to the minutes to the consumer, and they just print revenue. I don't remember the number, but it's kind of grocery store margins, like 4% or 6% or something. But it's riskless. Your Finger is able to buy the minutes at a discount and then immediately sell them online or at stores, and they sell out. And then they take the resultant revenue and do it again and again and again. And Finger now has, my understanding is, something like $5 or maybe almost $10 million in cash. This is the first time in their history they've had that much money that they can dedicate to essentially printing money by buying these minutes at a discount and then reselling them. And the demand is huge in a country that has 1 billion plus people. The second area that they have is, and it's related, it's all related, but they have big data. The phone in China can track, as it is here in the United States too, but it can track wherever you go. And the rules are a little bit different in China, but apparently, if you're at work and on the way home you stop at a bar and then you arrive home late, or you spend a long time in the bathroom, or you weave on the way home, or you show up at work late. They build that database, and it affects your social credit score. More importantly, from a revenue standpoint, it affects things, and this goes into the third area. But for right now, the big data that they accumulate can be mined for revenue. Well, going to the third thing, it's insurance. They have demand for this data, life insurance, health insurance, etc. And the big insurance companies from around the world want to get that data. And they just got a contract for the warranties on the phones. So Finger has a tremendous fundamental story. But when they borrowed some money from the Lin Partners, all of a sudden, the stock started going down. And recently, retail buying came in, and the stock went from the destroyed price that the Lin Partners probably, in my judgment, orchestrated or did themselves. They destroyed this price down to 60 cents or lower. This is a stock that was uplisted to NASDAQ. They took it from $9 down, and it suddenly rallied. Well, guess what? Somebody, and you can be pretty sure who it is, shorted over 100 million shares in about 6 weeks. And this is a company that has an effective float of 3 to 5 million shares. It's just absolutely leaves your mind just spinning. And then those are both the Lin Partners victims. There's a group called Power Up, Geneva Roth Holding, Kurt and Seth Kramer. Just Google Kurt Kramer, CURTKRAMER, and his SEC. Just do that. And their sidekick, Charlie Mayo. They lent money to GTII in a death spiral note. And this was in November of 2020. It's late if I have it wrong. I don't think I have it wrong. And the chairman of GTII, David Reichman, quickly saw the danger of this and bought the note back in February of 2021. Well, all these guys know how to do, these geniuses, is to short. Now they borrow money from their prime broker, who reportedly is Alpine and may be in trouble. Everything I'm saying is based on information I have, but it's all my opinion and judgment. As I think, before they signed the note, during the note, and afterward, they just shorted the stock into oblivion, and they've done this to dozens of companies. They got busted for usury in New York, so they moved their operations over here on Diagonal Road in Alexandria, and the government lets it keep going. Just lets it keep going. It's 3 strikes, you're out if you are a certain kind of American. But in the Wall Street space and the off Wall Street space, like the Kurt Kramers spend, you make money, you generate commissions, you generate revenue, and everybody looks the other way. Everybody. So they drove GTII down, and when the note got bought in, the company did the right thing. But instead of just accepting their losses and buying back in, they doubled down, Kurt Kramer and the rest, and just sold. So you have in GTII over 200 million shares naked short, a company that has fundamentals coming in that are huge. And of course, all 3 of these stocks have been under the attack just recently, since Thanksgiving, just devastated. And the government does nothing about it. The regulators do nothing about it because it benefits Goldman Sachs at all. That's the bottom line. Goldman Sachs and the other big firms, and Ken Griffin and Cohen and all that, get to remove wealth from the financial markets while destabilizing those financial markets. Imagine if in all of your accounts there's only one real share for every hundreds of shares that have been stuffed into your accounts by the likes of the Lind Partner, the Kramers, and other groups like this. And you think because it's all electronic that you can trust it. What happens if it all busticates, as my dad used to quote people that he grew up with? We don't have the wealth we thought. And it's all out of greed. It's all out of greed. It's leveraging the trust and faith of the American people while destroying the American dream, just for the greed of a few. And it's despicable. It's absolutely despicable. And the idea that people like Gary Gensler, who is an alum of Goldman Sachs, is actually guarding the hen house, and then people in Congress get donations from Goldman Sachs, and now the proposals coming up before Congress are a bunch of confusing, we're going to bring back the uptick rule, and we're going to stop payment for order. That's not the issue, Gary Gensler. The issue is stuffed in Americans' accounts, probably on a worse ratio than the fractional reserve banking system is a fractional reserve custodial system in securities, or a fractional reserve security system, which allows Goldman, Morgan Stanley, Merrill Lynch, Wells Fargo to expand assets under management probably more than 10 to 1 and then charge fees, make their money in stock loan, make their money in margin interest, make their money on prime brokerage, And these are all the too big to fail banks that you, the people watching this, bailed out. And now they're bigger and the risks are bigger. All out of greed. And this time, I don't think anybody can save them. There's not enough money to save what's coming. But anyway, let me just stop right there. I highly recommend that you take a look at CRTD, FNGR, and GTII, and there's some other stocks that I've recommended recently, but I want to focus on those three because those three are the ones in this video I want to focus on. Those three are the ones that Jeremy here and a group of investors and a gentleman called Ham, you can go to Twitter, Ham at Ham Short Killer on Twitter, and a group of investors, a group of the original GTII Army, research sites, and have been fighting. And this, I think, is reaching a point where it's unstoppable. So anyway, I'm going to leave it right there. I didn't mean to say all that, but I commend so much the courage and the abilities and the fight in this gentleman, Jeremy Frommer. And I congratulate Ham and all of the investors and everyone in the GTII Army that's not quitting. All right. Good night.